Hello, Dmitry Bondar there. I'm sure you have heard about one of the most prominent financial YouTubers of 2020, Meet Kevin.
What's up, everybody? Meet Kevin here.
Hey everyone, Meet Kevin here. Hey everyone, Meet Kevin here. Whew. All right.
He built his wealth on his real estate deals plus significant growth of income from YouTube. In 2020, just in 12 months, Meet Kevin turned his 70,000 stock portfolio into a real fortune, with now about $20 million.
Which I kept telling myself is stupid, Kevin, stop buying!
And thanks to his stock picking approach, aggressive investing strategy, and balancing the portfolio in a particular way, and maybe some luck, I don't know, he reached that a fabulous amount of money. Kevin in his last video, link will be in the description, revealed his $20 million investment portfolio and shed some light to his total margin. I bought his investment course, and as a member of his closed Discord community, I have access to some data that are not publicly available. So in this video, I more deeply analyzed all his stock portfolio.
Gosh, come on!
His investment style, his risk tolerance, and patterns. I will show you data from all his platforms he uses, such as Robinhood, M1 Finance, Webull. Maybe it will help us to understand which companies he prefers to invest, as well as in which sectors it's better to invest for me and you.
Now I know there's been some pain in the market lately.
And my quick disclaimer, I'm not a financial genius, I'm just a YouTuber, I'm an investor with a small portfolio, maybe 20 times less than Kevin's. I really respect Kevin and his self-made success and want to learn from him by analyzing his actions.
So I'm still kind of shaking right now.
So smash the like button, subscribe button, and let's go! Okay, so the first things first, how Meet Kevin portfolio look in general? He revealed his full investment portfolio in one of his videos, but he didn't analyze it deeply. He kept all his investment funds on several platforms, mostly on Webull and M1 Finance, but some stocks, options and crypto on Robinhood and TD Ameritrade. I noted that he borrowed money from Chase because it's a damn cheap, and then he transferred funds to the platform he wants. Why? Because Chase give him a better rate, about 1.59% comparing to Robinhood rate 2.5%, or Webull about 4.5%, or M1 Finance margin rate about 3.5%. Okay, what I did next? I put all his investments in one table to see the full picture in general. So here is a table with all his investment on different platforms. One more important disclaimer, in this pie you will not see his investments in crypto. In his video from the 15th of March, link will be in the description, Kevin revealed that he holds about 15 bitcoins. In current price it will be about $900,000. So it's about 5-6% of his total portfolio. And in the same video he told that he planned to increase the percentage of Bitcoin in his portfolio. So now let's try to analyze and understand his investment portfolio. I see that the top 5 of his favorite companies are Tesla, Apple, Etsy, and Enphase Energy, Redfin, and Amazon. All these stocks are mostly growth stock. Amazon and Apple growth is not so rapid, but could be considered as a stock with significant growth potential. And all these 6 stocks are 80% of his total portfolio. Moreover, these 6 stocks are mostly from high-tech companies in some, and also he is very bullish on Tesla, with a significant portion of these specific stocks, about 58%. Wow!
I've over 5x'd my money investing in Tesla stock, which is one of the reasons I did end up getting this Tesla Roadster.
Not a very well diversified portfolio, but on the other hand, these particular companies demonstrated the biggest growth over the last year. So it seems like those stocks are basically carrying his portfolio up. Now let's take a look at the sectors that are overrepresented or underrepresented in his portfolio. As a rule of thumb, a well-diversified portfolio should have access to as many sectors as possible and not concentrate too many funds into one single sector or related sectors. For example, if you want to diversify your portfolio within specific sectors such as biotech, commercial real estate, or I don't know, gold miners, you simply have to keep your allocation up to 5% or less for each. And basically there are 11 common groups of investments: energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunication, utilities, and real estate. In the situation with Meet Kevin's portfolio, most of the companies are in energy and information technology sector. Those that are underrepresented in the portfolio are healthcare and utilities.
Oh my gosh.
By the way, in his most diversified buy on M1 Finance platform, he has 59 stocks. As we can see, the greatest majority of them are electric vehicles and energy. This category makes up 34% of the whole portfolio. Consumer online retail is the second biggest part of his portfolio, and it's about 19%. After that goes a tech category with the figure about 17% and a tech consumer about 12%. So more than a half of the portfolio on a M1 Finance brokerage relates to new technologies. It's a fast-growing industry and there are many great companies to invest in. And that's cool. And we all know the rule not to put all the eggs in one basket. If the industry of energy will experience obstacles, the industries that depend on it will also have hard times. As a result, the stock price of the companies that comprise the biggest part of Meet Kevin's portfolio will go down and he will not have anything to balance it.
You have got to be kidding me. This is so frustrating.
It's just my humble opinion. Who I am to advise Meet Kevin? Okay, now what about Meet Kevin's investing style and what impact it has on his portfolio performance? An investment style is often distinguished by growth versus value. Growth stocks are considered stocks that have the potential to outperform the overall market over time because of their future potential, while value stocks are classified as a stock that are currently trading below what they are really worth and will therefore provide a superior return in future. The portfolio mainly consists of companies with above average growth that reinvest their earnings into expansion, acquisitions, and/or research and development. And growth fund is a diversified portfolio of stocks that has capital appreciation as its primary goal. One more distinguishing feature of growth-oriented portfolio is that it has little or no dividend payouts. So let's look at the Meet Kevin's portfolio index fund on M1 Finance. Its performance is about 192% and a dividend yield 0.664%. So taking into account these figures, we can say that his type of investment portfolio is a growth-oriented. By the way, in his online course, he explained his investment style and why he doesn't care about dividend stocks. When you have 30-year investment horizon, you have to focus on building wealth aggressively, and dividend stocks are not the best choice for this. Until I completed his online course and made this video, I was very interested to understand how he picks stocks. So, before buying the stock, he does a deep research of the company and predicts its growth. He doesn't pick new IPO stock because it's a kind of gambling, but he also don't invest in old school dividend stock or very stable assets like a wheat, copper, oil, etc. He prefers something in the middle, undervalued companies with a significant growth potential. And what I also like, that if he wants to invest, he always does his homework, doing fundamental analysis, reading SEC filing reports. SEC filing are regulatory documents that companies and issuers of securities must submit to the Securities and Exchange Commission, SEC, on a regular basis. And he also does fundamental analysis using NPV, discount rate, cash flow and other indicators, and of course earning per share. So look at this picture, it's just a part of his stock pick and analysis approach. In my opinion, that's a very serious approach we all can learn from. Okay, now what is his risk-based investment style? Meet Kevin investing in companies that have high growth potential, including newer companies and those in a hot sectors of the economy. It very well describes his style of investing. And this style of investing helped him to grow from 200,000 to 20 million, which is really incredible. But oh Jesus, his level of margin is sometimes around 60%, which is a very dangerous even for such an experienced investor as a Meet Kevin. A person who has more than 30% of money in margin takes a big risk, very big risk. So the risk of trading with a 60% of margin is really enormous. So if something goes wrong, Meet Kevin can lose more than a half of his fortune. And some of his posts in a closed Discord group confirm my concerns. And you could be an aggressive investor only if your risk tolerance is a very high, and Meet Kevin definitely has very high risk tolerance. Risk tolerance is investors' ability to psychologically endure the potential of losing money on an investment. A person's risk tolerance can change throughout his life, of course, and determines what type of investment he or she is likely to make. And yes, I understand Meet Kevin's net worth right now about $20 million according to the last video, and that's why his risk tolerance is very high. He understands that if something wrong happened, he could earn more money from YouTube or from real estate, so that's why he can invest in really aggressive assets. Okay, what is my conclusion? All in all, the strong size of Meet Kevin's portfolio and strategy are the good choice of stocks to invest in. But there are also some cons in his strategy, of course, like having about half of all stocks investment in one company or utilizing the very high level of margin. And let's imagine for a second that one day Tesla could have gone bankrupt. If this happens, no, please no, I invest in Tesla as well, Kevin will lose more than a half of his fortune, about 10 million. And a final risk for all of us in having too much invested in a single stock is that even if it does not go down, it will likely not keep up with the broader market. So most of the returns in any given stock index come from a relatively small number of companies. And most investors would be best served by reducing concentrated stock positions in a favor of one of these broader indexes. And of course, everyone should use less as possible amount of margin, because that's really dangerous and can ruin all your investment portfolio. It's important to understand that ideal portfolio does not exist, so there are mistakes even in the successful portfolio of Meet Kevin and vice versa. Thank you guys, and I hope this video was helpful for you. Press the like button and subscribe on my channel. Who's else a financial portfolio or profiles you want me to analyze? Maybe Andrew G, Graham Stephan, or Jeremy Lefebvre, financial education, or Bihaza will be the next one for my analysis. Please leave your comments and I will do it. Thank you for watching and peace out.